Hey everyone, welcome to the Explainer. I'm absolutely thrilled you're joining us today because, look, we're tackling something literally every active market participant struggles with, turning all that intraday market chaos into a structured, highly readable map. Today, we're exploring the Quant Gem AutoAVWAP v2.1 Intraday Market Structure Manual. We're going to break down exactly how to stop guessing and start actually reading the structural terrain of the market.
Let's face it, day trading can often feel like you're trying to navigate a ship through a hurricane blindfolded, right? The noise, the erratic price action, those sudden whiplash reversals, it's just exhausting. But what if you could completely flip your perspective? I want you to look at AutoAVWAP not as some, magical buy or sell cheat code, but more like a master cartographer's tool. It's built to map out these dynamic value zones and definitively answer the biggest question of all. Who is actually in control right now? The buyers or the sellers?
Okay, let's dive into this playbook we've got lined up. 1. Mapping market value. 2. Decoding the signal families. 3. Grading your setup. 4. The golden rule of risk. And 5. The intraday playbook. Section 1. Mapping market value.
So to start our expedition, we really need to lay down the foundation. Every good map needs its latitude and longitude. And in the market, that means defining our intraday value zones. So here is your foundational map, the AVWAP value map. The indicator plots 3 anchored VWAP levels for us. The upper AVWAP acts as a reference for upside behavior, basically forming dynamic resistance. The lower AVWAP, it does the exact opposite. It tracks downside behavior acting as dynamic support. But look closely at that third level in the middle AVWAP. This right here is the equilibrium. It's your fair value line. I honestly cannot stress this enough. This is the equator of your map and literally the single most important level on your chart. If price is above it, buyers have control. If it's below it, sellers are in charge. And if price is just kind of hanging out near the mid-AVWAP, well, the market is balanced. It's a tricky decision zone and you need to be really careful.
Now, a map isn't just about the ground you're walking on. It's about the environment around you. Think of the background color bias on your chart as the macro weather. A green background means price is broadly holding above the VWAP structure, meaning buyers are in charge. A red background? Price is holding below, so sellers are running the show. And what if there's no clear background color? That means the weather is mixed and price is stuck inside that value zone. So why does this all matter? Well, because if the market weather completely disagrees with your trade idea, you absolutely must demand significantly more confirmation. Or honestly, better yet, just stay on the sidelines. You wouldn't sail a ship straight into a storm for no reason, right?
Section 2. Decoding the signal families.
All right, now that our structural map is drawn and we know how to read the weather, we've got to decode the legends. The system actually uses 2 distinct signal families, and you really have to know the difference. First up, we have pullback signals, which are labeled as P_buy and P_sell. These are your mean reverting entries within an already established structure. So, P_buy literally means you're buying the dip in an uptrend, while P_sell is selling the bounce in a downtrend. And then second, we have trend signals, which are just labeled buy and sell. These are your momentum continuation entries. You're basically joining an active trend right after momentum resets. And the absolute beauty here is that these signals are filtered against overextension. Because, let's be real for a second, we've all made that classic amateur mistake of blindly shorting a market just because the price looks too high, right? Yeah, we've all been there. Well, this system's internal filters, which are checking participation, candle quality, and structure, are specifically designed to stop you from doing exactly that.
Section 3. Grading your setup. Now, what's really interesting about this slide is understanding that not all paths on our map are equally safe. Notice the clear distinction here between the actual quality of a signal and the context of a trade. Every single signal gets a grade based on volume participation, candle strength, slope agreement, and its distance from value. An A+ is your strongest confluence. This is perfect for your normal position sizing. An A is good, it's very tradable, but it heavily relies on you verifying the context first. And a grade B, it's still valid, but it has much lower confluence. This is where you'd want to reduce your size, or maybe only take it if the broader structure is just screaming in agreement. You have to remember this: the grade is not the trade. The system is just grading the setup's quality. You, the human pilot, you have to supply the context.
Section 4. The golden rule of risk. Okay, I want to slow things right down here for a minute, because no matter how brilliant your map is, if you don't respect the boundaries, you are going to crash. So here is exactly how the system protects you. Every single signal label comes with a built-in stop loss and a target level. But it doesn't just throw out a random fixed number of points. No, the stop loss is volatility adjusted. It dynamically adapts to exactly how the market is moving right in that specific moment. And the target is formulated on a strict risk-reward multiple. This completely removes all that emotional guesswork from setting your trade boundaries. Your lines in the sand are drawn for you based purely on current data.
Listen to this rule and really just let it sink in. If the signal is valid, the plotted stop is the invalidation level. Never widen the stop after entry. This is absolutely non-negotiable. The plotted stop isn't just chart decoration, okay? It is the exact mathematical point where your trade idea is definitively proven wrong. So, if that stop is too wide for your personal risk tolerance when the signal fires, the answer is absolutely not to widen it or just sort of ignore it. The answer is simple. You either skip the trade entirely or you drastically reduce your size.
Section 5. The Intraday Playbook. Let's move to and see how this builds into a seamless daily workflow, bringing all our cartography tools together for the actual expedition. Step 1. Read the structure. Are we looking at a bullish, bearish, or sideways market? Step 2. Use the daily range projection. If price is breaking above the projected range, you've got bullish expansion. If it's inside, the market is just rotational. Step 3. Match the signal type to the conditions, meaning only take P-buy dips when the broader bias is actually undeniably bullish. Step 4. Respect the stop, which, as we just discussed, is strictly non-negotiable. And finally, Step 5. Exit intelligently. The target is your first objective to book partial profits. But hey, if price continues with absolute strength, you can always trail your stop using that vital mid-AVWAP line. This matrix right here is your daily compass. On a bullish day, where price is sitting above the mid-AVWAP and your background weather is green, you are strictly looking for P-sell on dips and buy on continuation. You just ignore the short signals completely unless major resistance breaks the structure. On a bearish day, it's the exact inverse. You hunt for P-sell on bounces. But look at row 3, the range day. This is where price is just sort of rotating around that mid-AVWAP, and the background keeps flipping back and forth. Here, you only take clean A-plus pullbacks near the extreme edges of the range. I want you to ask yourself honestly, how many times have you been completely chopped up in bad trades simply because you were treating a range day like a trend day? Having this mapped out prevents exactly that.
But look, even the best map in the world can't stop the ship from sinking if the captain ignores the warning signs. You absolutely must stand aside during low-quality conditions. If price is just chopping tightly around the mid-AVWAP, stay out. If buy and sell signals are suddenly clustering super close together, the market is confused, so don't join the confusion. Watch out for incredibly narrow, unexpanded daily ranges, and of course, step back during major news volatility. The indicator filters out a massive amount of noise for sure, but remember, you are the pilot here. You have to supply the market context.
So the crucial point is really captured in the core thesis of the entire manual. AutoAVWAP is not a buy-sell indicator. It is an intraday market structure system. If you approach this tool looking for a magic machine to just tell you exactly when to click a button, you are completely missing its profound value. You trade long when the structure is bullish, you trade short when the structure is bearish, and you protect your hard-earned capital by reducing your activity when price is trapped in that messy mid-value zone.
I want to leave you with this final paradigm-shifting question. How will changing your lens from trying to predict the market to simply reacting to its structure change your very next trade? Because when you finally stop guessing what the market should do and start reading the map of what it is actually doing, everything changes. Thank you so much for joining me on this explainer. Keep those maps clear, always respect your risk boundaries, and I'll catch you next time.